You found the lot, you ran the numbers. The pro forma makes sense. But taking a multiplex from an empty dirt lot to a finished building requires money. And that is where most first-time developers hit a wall. The successful projects usually look entirely boring on paper. The disastrous ones look exciting. And the difference between the two almost always comes down to a gap in the financing. Keep in mind this is general industry information, not lending or financial advice. Every site is unique, so talk to your commercial broker before you sign anything. The central trap catching most new investor builders is a failure to account for the capital stack. In reality, the project depends on two separate loans, operating on completely different timelines. Treating those two loans as the same thing is the fastest way to bankrupt a build before you even pour the foundation. You have to understand how they conflict. This chart breaks down the two phases. On the left is construction financing. This pays for the actual build. It's a short-term loan, running 18 to 36 months, and the capital is expensive. Conventional BC lenders price this at prime plus 1.5% to 2.5%. They also cap your leverage at 65 to 75% loan to cost. That means you need to bring 25 to 35% of the total project cost as cold hard equity. There is a high leverage alternative. CMHC's apartment construction loan program can push all the way to 100% loan to cost at below conventional rates. You need a minimum of 5 units, $1 million loan size, and 4 to 6 months to close. Once the building is finished and rented out, you enter phase 2, the term takeout. This is the permanent mortgage you'll hold for decades. It pays off the expensive construction loan. This is where CMHC's MLI Select program comes in. Scoring 50 points for affordability, efficiency, or accessibility permits 95% loan to value. Reaching 100 points extends the amortization out to 50 years. But CMHC instituted a strict rule change in 2026. Every rent must be supported by a signed lease or a market appraisal at close. You can no longer underwrite based on projected rents during lease-up. If you only budget for this final term takeout and ignore the heavy equity requirements of the construction phase, your project will run out of cash midway through the framing stage. Before a lender wires a single dollar, they want absolute certainty. That starts with a fixed price contract. They will not finance a cost-plus arrangement, and they will not accept a friend acting as a casual project manager. Your general contractor needs a proven track record. The lender expects to see a reference sheet listing at least 3 comparable multi-unit projects they have successfully completed. They also require a full appraisal. Under MLI Select, that means a detailed market rent survey and a stabilized value based entirely on rents you can prove today, not the numbers you hope to hit. Then comes your contingency buffer. Expect a strict 10% minimum holdback on hard costs. If you are building in Victoria or anywhere on Vancouver Island, where trade availability is extremely tight, lenders will push that requirement to 15%. Commercial underwriters will also scrutinize your personal credit. Across BC, 680 is the absolute floor for construction financing, with scores of 720 or higher securing the most favorable terms. Underwriters do not view these demands as administrative paperwork. They are essential risk mitigation shields, designed to protect their capital from amateur miscalculations. Once you break ground, you face the mechanical reality of how construction capital actually moves. The lender does not hand you a check. They release funds in discrete stages, completely dependent on an inspector confirming physical milestones on site. Looking at a standard schedule, draws typically trigger at the land advance, foundation completion, framing, lockup around 40%, drywall at 70%. Those delays are directly tied to these institutional funding gaps. Layered on top of that is the BC Builders Lien Act. By law, your lender must withhold 10% of every single progress payment. Those funds drop into a separate bucket and are legally locked until 55 days after substantial completion. Completing a multiplex means surviving this exact gauntlet. You have to cash flow the combination of bank delays and mandated holdbacks. If you can't float the gap, your trades stop getting paid, and they will walk off your site. To prevent your site from grinding to a halt, you have to architect the project specifically for these financing constraints from day one. Here's the 4-step blueprint. First, model your 2 loans separately. Calculate your construction costs, interest, and contingency as one block, and run a completely separate term takeout underwrite based strictly on defendable current appraisals. Second, bring the actual equity the project needs, not just the minimum a program allows. If you underwrite right to the very edge of that 95% LTV limit, a single bad appraisal at completion triggers a capital call you cannot cover. Third, build the draw cycle into your general contractor's initial schedule. Have a blunt conversation about cash flow upfront. Ensure they possess the financial capacity to float 30 to 45 days without breaking. Fourth, secure parallel pre-qualifications from at least 2 different lenders to maintain your leverage. Compare a traditional bank against a regional credit union. For example, Vancity offers a specific multiplex product in the Lower Mainland that pushes to 80% loan-to-cost with 18 months of interest-only payments. Up Island, credit unions like Island Savings or Coastal Community are worth calling. Applying this blueprint flips the dynamic. You stop being a reactive borrower, begging for capital, and become a proactive manager dictating the financial terms of your own site. Ultimately, lenders only deploy capital into projects that work in reality. That means proven rents, an experienced GC with a track record, and a float timeline you can actually carry. A full, uncut contingency budget serves as the ultimate signal of a professional pro forma, proving the project is grounded in actual BC market costs. If you are structuring a build right now, drop your specific unit count in the comments, and I'll outline exactly what BC lenders will look for on your site. Mastering multiplex finance requires looking past the final mortgage. It requires engineering the day-to-day cash flow necessary to actually survive the build.